So if you have been watching the news and you're starting to wonder, well, oh, we're in a bear market now. What now? Should I get out? Well, again, and I've talked about this before, is if you're going to think about getting out, the question is not really should you get out, but what are you going to do if you get out, and when are you going to get back in? Because if you get out, you have to be right twice. You have to be right about when you get out, and you have to be right about when you get back in. So since we're 20% off in the NASDAQ, we're already in a bear market. You are already wrong about when to get out. So now it becomes crucially important to be right about when to get back in. And if you believe in buying low and selling high, it's kind of hard to put that into practice right now unless you are thinking that this is going to be the high of the market for the next, year or 2 years. So it's really, really hard to make short-term predictions, and that's why we try not to do it here at the ministry. And, Financial Issues has always supported a long-term view of investing and encouraging people to not invest at all if you don't have the risk appetite for it, and to not invest if you don't have a long-term time horizon. So for most people, they have money that's going to meet different goals for them. Some money is emergency money that you're going to need if you need to put new tires on your car, or you need to supplement your budget because maybe you lose a job, or maybe you need to replace an appliance, or you have a claim on, you have an accident and you have to pay your auto deductible, or you have a claim at your house and you have to pay that deductible, or your medical deductibles. All of those really short-term needs, that money should never be invested in something that has the potential to lose money. So let's look at some other data. If we look at bear markets going back over time from 1947 to 2021, to September of 2021, they range in length, bear markets that is, range in lengths from 1 month to 1.7 years. And they can range in severity from a 52% drop to a 20.6% drop, which is just by definition, barely bear market territory. So, they can be pretty volatile. The last bear market that we saw, we don't have to go back very far to see it. It happened in March of 2020, right after the pandemic came out. And, if you got out, the market dropped very quickly by over 20%. And if you got out, you might still be sitting on the sidelines today. And what does that mean? That means that you missed all of the recovery. Even if you're down 20%, which most of you aren't if you follow the Financial Issues strategy as it's laid out, you're not going to have near the exposure to NASDAQ type investments as you would if you were just 100% in the index. So just because the index is down in bear territory or correction territory doesn't mean that your portfolio is. So now's a good time to look at your portfolio, refresh your memory about what you own, and remember why you own it. Further data tells us that if you do get out, 30% of investors who panicked and sold during a lot of downturns going back in history, never got back in. So what does that mean? The other question is, where are you going to go? Take a look at the yield in your portfolio. It's very likely, especially if you're following the strategy laid out by Financial Issues, that you have lots of companies that are paying dividends and have a strong record of dividends, and have companies that are flush with cash and don't have to cut their dividends just because of a temporary downturn. Even though the stock price may go down, may even go down dramatically, the income in your portfolio really isn't affected too much. So if you do go to cash and you're spending the dividends and income, or you're spending money that your portfolio has been generating, where are you going to get that interest? Are you going to get 1%, 1.5% in a CD. Is that going to be enough if you were taking, 3 or 4 or 5 or even a higher percentage of your portfolio? You're going to end up eating into your principal, which is something that is very dangerous to do, because once you spend down that principal, once you do decide to go back into the market, you have less money. Less money is going to generate less interest and dividends, and it becomes a vicious cycle from there. So look at what you have, remember why you have it, and make some good decisions that way.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.